In short, to increase demand and lift the economy, the federal government's most useful role is not to rush into a program of excessive increases in public expenditures, but to expand the incentives and opportunities for private expenditures. But you can understand that under these circumstances in general, that any new tax legislation enacted next year should meet the following three tests. First, it should reduce the net taxes by a sufficiently early date and a sufficiently large amount to do the job required. Early action could give us extra leverage, added results, and important insurance against recession. Too large a tax cut, of course, could result in inflation and insufficient future revenues. But the greater danger is a tax cut too little or too late to be effective. Second, the new tax bill must increase private consumption as well as investment. Consumers are still spending between 92 and 94% of their after-tax income. But that after-tax income could and should be greater, providing stronger markets for the products of American industry. When consumers purchase more goods, plants use more of their capacity. Men are hired instead of laid off. Investment increases and profits are high. Corporate tax rates must also be cut to increase incentives and the availability of investment capital. The government has already taken major steps this year to reduce business tax liability and to stimulate the modernization, replacement, and expansion of our productive plant and equipment. We have done this through the 1962 investment tax credit and through the liberalization of depreciation allowances, two essential parts of our first step in tax revision, which amounted to a 10% reduction in corporate income taxes worth $2.5 billion. Now we need to increase consumer demand to make these measures fully effective. Demand which will make more use of existing capacity and thus increase both profits and the incentive to invest. In fact, profits after taxes would be at least 15% higher today if we were operating at full employment. For all these reasons, next year's tax bill should reduce personal as well as corporate income taxes. For those in the lower brackets who are certain to spend their additional take-home pay, and for those in the middle and upper brackets who can thereby be encouraged to undertake additional efforts and enabled to invest more capital. And I am confident that the enactment of the right bill next year will in due course increase our gross national product by several times the amount of taxes actually cut. Profit margins will be improved, and both the incentive to invest and the supply of internal funds for investment will be increased. There will be new interest in taking risks, in increasing productivity, in creating new jobs and new products for long-term economic growth. Other national problems, moreover, will be aided by full employment. It will encourage the location of new plants in areas of labor surplus and provide new jobs for workers that we are retraining and facilitate the adjustment which will be necessary under our new trade expansion bill and reduce a number of government expenditures. It will not, I'm confident, revive an inflationary spiral or adversely affect our balance of payments. If the economy today were operating close to capacity levels with little unemployment, or if a sudden change in our military requirements should cause a scramble for men and resources, then I would oppose tax reductions as irresponsible and inflationary, and I would not hesitate to recommend a tax increase if that were necessary. But our resources and manpower are not being fully utilized. The general level of prices has been remarkably stable, and increased competition, both at home and abroad, along with increased productivity, will help keep both prices and wages within appropriate limits. The same is true of our balance of payments. While rising demand will expand imports, new investment in more efficient, productive facilities will aid exports, and a new economic climate could both draw capital from abroad and keep capital here at home. It will also put us in a better position, if necessary, to use monetary tools to help our international accounts. But most importantly, confidence in the dollar in the long run rests on confidence in America, in our ability to meet our economic commitments and reach our economic goals, in a worldwide conviction that we are not drifting from recession to recession with no answer. The substantial improvement in our balance of payments position in the last 2 years makes it clear that nothing could be more foolish than to restrict our growth merely to minimize that particular problem, because a slowdown in our economy will feed that problem rather than diminish it. On the contrary, European governmental and financial authorities, with almost total unanimity, far from threatening to withdraw gold, have urged us to cut taxes in order to expand our economy, attract more capital, and increase confidence in our future. Our true choice is not between tax reduction on the one hand and the avoidance of large federal deficits on the other. It is increasingly clear that no matter what party is in power, so long as our national security needs keep rising, an economy hampered by restrictive tax rates will never produce enough revenues to balance our budget, just as it will never produce enough jobs or enough profits. Surely the lesson of the last decade is that budget deficits are not caused by wild-eyed spenders, but by slow economic growth and periodic recessions. And any new recession would break all deficit records. In short, it is a paradoxical truth that tax rates are too high today and tax revenues are too low. And the soundest way to raise the revenues in the long run is to cut the rates now. The experience of a number of European countries and Japan have borne this out. This country's own experience with tax reduction in 1954 has borne this out. And the reason is that only full employment can balance the budget, and tax reduction can pave the way to that employment. The purpose of cutting taxes now is not to incur a budget deficit, but to achieve the more prosperous, expanding economy which can bring a budget surplus. I repeat, our practical choice is not between a tax cut deficit and a budgetary surplus. It is between two kinds of deficits: a chronic deficit of inertia as the unwanted result of inadequate revenues and a restricted economy, or a temporary deficit of transition resulting from a tax cut designed to boost the economy, increase tax revenues, and achieve, I believe this can be done, a budget surplus. The first type of deficit is a sign of waste and weakness. The second reflects an investment in the future. This nation can afford to reduce taxes. We can afford a temporary deficit, but we cannot afford to do nothing. For on the strength of our free economy rests the hope of all free nations. We shall not fail that hope, for free men and free nations must prosper and they must prevail. Thank you.